to that and how your money can work in two places at once very powerfully. Barry, welcome. As always,
Thanks.
great to have you. As people are jumping on, let's dive in.
Yeah, good to be here. Thank you so much. I'm going to start off right here, the bang, right in the beginning, and we're live. This is live.
Yes,
We're
live
hoping all
webinar.
goes well. So
Uh,
everyone out there, we are on the FDIC website. I'm going to copy this link right here because some of you might want to go look at this and verify it yourself. I'm going to put this in the chat. It's a huge link. To get to where we are today takes a lot of digging. This is the bank find suite, the financial reporting, and we're going to look at some bank assets. What are they doing that we can be doing or should be doing? Some of us are doing. We're going to click on financial regulatory search and reporting, and we're going to look at just three banks. There's a lot we could look at. You come over here and we're going to type in first US Bank right in the FDIC website. So we're going to pull up US National Bank here. We're going to select a report. This is fourth quarter 2024. First quarter 2025 isn't quite out yet. And we're going to come to the assets, liabilities, and capital. Matter of fact, this I go through in more detail in my book, Live Rich, Die Rich. We'll talk about that. Steve's got a book called The Ultimate Asset. You might want to go in to this website yourself. And you see I'm continuing to dig. Now we're going to go to total liabilities and capital. And then we're going to click on memoranda, assets, liabilities, and equity. And I'm going to point something out. What I want to point out is this line item right here that says life insurance assets. 7.7 billion. That's
billion
B
with a B.
as in billion. That's right. Yep, 7.7 billion. Okay, let's go back. Let's look at another bank. Let's go to how about Wells Fargo? Bank name, Wells Fargo. You can see they have total assets of 1.7 trillion. Well, how much life insurance are they carrying? Assets, liabilities, capital. Same section, memoranda assets, life insurance assets, 18.3 billion. Like crazy numbers. One other, well, let's look at JP Morgan Chase, FDIC, bank name, Chase, JP Morgan. Make sure we get the right one here. Yep, because they have 3.4 trillion in assets, probably the largest, if not one of the largest banks in all of the US. $3.4 trillion. That's a lot of money. Generate the report. And what do they have in life insurance assets? 12.6 billion. So the question is, why do these banks have cash value life insurance assets? But Steve, I think even the more profound question is, why don't they tell us they have these assets? Because when you walk into your bank, there's no one there selling you cash value insurance. What they're selling you are stocks and mutual funds. They want to set you up with their in-house financial advisor. So what's crazy is they're doing one thing, but they're selling another thing. So we want to break this down. This is the $130 billion secret that we're wanting people to be aware of. Why is the bank doing one thing, but they're telling us to do another thing? I think that's very crucial. And we're seeing it live right here in the FDIC website. And as we go through this, if you have questions, Steve, are you taking questions in the chat or is there a
Yeah.
question
Yep. I
box?
was going to interrupt you to mention it. So if you do have questions, anybody listening, we want to try to field them during the presentation. It's possible. If we can't, we'll circle back and address at the end, but feel free to leave questions in the chat. We'll watch for it, and if we can work it in, we'll try to answer it on the fly for you. We like that participation from you guys, so feel free.
Yeah. And there's something else I want to address here, because when you do talk to a banker or a financial advisor, they're talking about diversification. We want you to be diversified in your portfolio, but they mostly want your money in the market. And true diversification is not different mutual funds, stocks, or ETFs. True diversification is different asset classes, not just the market. It's real estate, it's cash, it is stock market, like we've talked about. Could be a business, gold and silver, crypto. I think crypto is an awesome asset class right now, particularly Bitcoin, Ethereum, Solana. There's some others out there. Bitcoin primarily, commodities, oil and gas, and then cash value life insurance. Does everyone need to be truly diversified? Not necessarily. I think it could be a smart thing to do. What I'm wanting here, what I'm really wanting to do here, Steve, is to bust a myth. And the myth is that diversification is different mutual funds or stocks or ETFs, all market based. That isn't true. And most financial advisors in Wall Street will tell you, hey, get truly diversified. But when you look at that model, it's still all in the stock market. What I'm saying is, if you are going to be diversified, you need different asset classes. Now, you'll look at some of the wealthy people throughout history, and some will say, don't be diversified. Put all your eggs in one or two baskets, baskets that you know really, really well. This is a personal decision. For me, I own real estate. I'm sitting on some cash. I have stocks. What I don't have is a 401k or an IRA. I don't have a government qualified plan, and there are reasons that I don't. I've got crypto, I've got gold and silver, and I have multiple cash value life insurance policies. But if you ever hear a financial advisor say, oh, you need to be truly diversified, or we need to diversify your portfolio beyond where it's at now, you should say, well, yes, let's go into different asset classes, not more market-based investments.
And you've got a background in this too, Barry, that you might want to share so that people know that you came from a traditional financial advisor role.
25 years ago, you're right. I was securities licensed. I was putting my own money and my clients' money into the stock market, mutual funds, IRAs. And what I determined and discovered was that there's a ton of issues. Clients would call me and say, hey, Barry, why am I not earning the returns? Why am I losing money? And this went on for a year and a half. And I finally went back to my mentor because I was in it. I grew up watching my parents invest in real estate. So I thought, oh, this will be cool. I'm going to get into the market and help people invest in the market. But I went back to my mentor and I said, hey, what do I tell my clients? They're not making money. Some of my clients are losing money. I'm losing sleep at night. They're losing sleep at night. What do I tell them? And his answer was, tell your clients they're in it for the long haul. And it just didn't sit well with me. I mean, to give that answer over and over again, Steve, was very uncomfortable. And some of these people were my own family members, and it just was uncomfortable. So it was that experience 25 years ago that forced me, right? I wanted to go find something better. And that's when I got into real estate investing and high cash value life insurance, for some of the reasons we're going to talk about today, and for reasons why the banks have billions of dollars of life insurance.
Yeah, it's hard to measure that recommendation that you received, Barry, against statements that I believe Buffett made the statement at one point, maybe never lose money, I think is what he advised. So doesn't seem real consistent when you think about it.
Yeah. And I've often given this analogy. So everyone listening, think about this. If someone came to you with an investment and said, I want you to put up all the money, I want you to take all of the risk, I'm not going to tell you what future tax rates will be. There are going to be some fees and charges internally that I'm not going to disclose. And at the end of the day, you're not really going to know how much money you'll have. Would anyone out there just logically do that investment? Most of you say, no, there's no way. But the amazing thing is that what most people are doing today. When you look at a 401k investment, an IRA investment, a mutual fund investment, everything that I just described is a part of that type of planning. And here we are trying to set ourselves up for a nice retirement, but the system that most people are primarily putting money into is flawed. It's broken. And we're gonna get into that right here.
Yeah,
Any
and disclaimer,
thoughts?
if you have a 401k, we're not saying go and immediately cash it out or anything like that. You need financial advice on that as well, but what we're wanting to do is shed some light into some issues that are presented with traditional and just relying solely on a lot of the traditional advice.
The issue that I have with it, Steve, is this is where most people's money is. So when they get to retirement, they're really counting on Social Security and what they have in their 401k or IRA. That is not true diversification, right? That to me, that's risky. And most investors, we want to be called investors, but honestly, most investors are speculators. We're crossing our fingers, we're hoping for a good outcome, but we don't know. There's so much uncertainty around what I've just mentioned. And you're right, we're not telling people don't do a 401k, don't do an IRA. There's a place for that, but you shouldn't have all your money there. And I've seen in my 25-year career, a lot of people, that's where most, if not all of their money is.
Yeah,
So
if you guys have been around our community, you've probably watched Barry do a little bit of presenting on tax-free retirement, which is another webinar that I'm sure we'll zero in on at some point. And I think that's what we're talking about, right, Barry? That when you talk about having a tax-free bucket for your retirement, you're starting to attain true diversity at that point.
and we all want tax free. There's no one that I've ever asked that question to that has said no. Everyone wants tax free. But you're listening to this, ask yourself the question, how much of your portfolio or retirement is or will be tax free? And most of you, I believe, are going to answer none or maybe very little of it. So we want tax free. Why don't we have it? And I think it's because we've been taught, we've been educated primarily by these powerhouse investment companies, the Charles Schwabs, the Fidelities, the Merrill Lynches, the JP Morgan Chases, right? Edward Jones, all these companies, they want your money in the market for as long as possible, really till the day you die. And they'll continue to earn the fees. They'll continue to be the ones that generate wealth. We're just saying safely, um, effectively, don't have all your money there. And what we're going to present to you today is an alternative that has many benefits that the stock market doesn't have, that should seriously be considered. And the reason I started with the FDIC bank websites was because I want you to see these are banks that are doing the same thing, corporations, wealthy individuals. There's so much social proof out there. You've got to dig for it, but it's everywhere.
Thank you
The
for your
flaw,
question. Sorry, Barry. Thank you for your question, Nancy. We are going to offer a recorded version of this. We would encourage you guys, if you can, though, to stay just because this is a forum to help get questions answered. I know that many of you are going to have questions as we keep rolling, so we hope to answer them. But yes, we do provide that. So thanks for your question.
the flaws in conventional advice that perhaps are costing you millions. Volatility. There are no guarantees in the stock market. There are no guarantees in crypto. There are no guarantees in real estate, right? There's volatility that's going to happen. Some years you'll do well. You might earn 12, 18, 24% returns. But on the flip side, there are some years you might lose 8%, 15%, 30%. If you look at a 10-year time frame, like any 10-year time frame of market-based investments, historically there are 2 to 3 years of losses. You've got to take that into consideration. So volatility is huge. The second is fees. There are fees that most of you are being charged that you don't even know you're being charged. It's just the way it works. And internally, if you have a mutual fund or an ETF, that money manager can buy and sell and move stocks in and out of those funds. There could be internal tax implications. There could be losses. You're paying for that, but they don't need your permission,
Oh,
right?
wait a minute, Barry. Aren't you an evil insurance guy that you're charging
So
commissions? Maybe we should address that.
I'm glad you brought that up.
Yep.
As an insurance advisor, we do earn a first year commission and then a small renewal thereafter. But what we're not earning is a fee off of your entire portfolio balance year after year after year. So, yeah, we do earn an upfront commission. Now, the type of policies that I design, they're low commission, which you'll see here in a few minutes. But it's a great point, and you'll hear guys like Dave Ramsey say, don't ever buy whole life insurance because these life insurance agents are making huge commissions. And Dave's talking about this old style traditional whole life death benefit. Some of that might be true, but not in the type of policies that we design. And we can show over time the fees that you pay through a lifetime are 9 to 10 times less in a life insurance policy, if it's properly structured, than the fees that you're being charged in your portfolio, because that money manager, Wall Street, whoever the company is managing your funds, they're earning fees off of the entire balance, not just the money that you put in a given year.
Yeah, and if you hear the advice, don't ever, you might want to be skeptical, just as speaking, I guess, as an estate attorney that's been around a lot of financial people, and one of my biggest convictions coming from the background that I do is that you got to have a really good picture of somebody's situation before you give advice. And I guess that's my grievance there with some of the boilerplate stuff that's out there.
Yeah, and Steve's using some legal jargon as an estate attorney. That boilerplate is like a blanket statement. You
Oh,
can't make a
jargon
blank,
alert.
yeah. Yeah, you can't make a blanket statement when it comes to financial advice. Everyone's situation is different. You've got different goals than your neighbor. So we always want to make sure that we're looking at your situation specifically and then meeting your goals. Blanket advice can be harmful. Number three, another flaw in conventional advice would be taxes. And look, if you talk to your CPA, they want to feel real good about the taxes that they save you in one given year. Most CPAs aren't doing future tax planning. They're saying, hey, look at all this tax I saved you this year, which is why they're encouraging you to max out your 401k, max out your IRA, because it's tax deferred money. You're not paying the tax on it right now, immediately in this year. But what most CPAs aren't telling you is the other half of the story, which is, oh, by the way, you will pay the tax on this down the road. We're just kicking the tax can later down the road. That could harm you. We don't know, again, what future tax rates will be, and maybe you'll be in a higher tax bracket. I don't know. Why leave it to chance? Why not have some of your money coming to you in retirement that is tax free, not just all tax deferred? All right. What's a solution? What are the options? What are the alternatives? Well, we want to show four unbeatable benefits of structured whole life insurance. And the reason we say they're unbeatable is because in my 25 years at least, I've never seen one product or one investment that does as much as a properly structured whole life policy. We're only talking about four benefits here today. We could go through about 11 or 12. There are many others. Number one, guarantees. So ask the question, what do you have in your portfolio right now that's guaranteed? In a life insurance policy, when it's properly structured with, we use mutual insurance companies, they provide a guarantee rate of return, which means you make money every year. And we're going to see this, so stick around because we're going to look at the illustrations. I'm going to show you the guarantees, and you're going to see that you not only make money every year, you make more money every year because of compound interest. So guarantees, you also get a guaranteed death benefit, other guarantees in the policy. And you're not locking up your cash. You have access to cash. Again, in a government qualified plan, you have to have money stay in that plan until you're 59 and a half. That's it. And if you try taking money out early, there's very few exceptions for this, but if you try taking money out early, you'll not only pay the tax, you'll also pay a 10% early withdrawal penalty. Why? Because they want to force you to keep the money there. Again, this is how money managers and advisors are making money off of your whole portfolio for a good portion of your life. But in these high cash value policies, you have access to cash 30 days after the policy's in force. So you're not locking up your money. There is no 10% early withdrawal penalty. And having access to cash, we love. We're going to teach you how to buy assets and create more wealth. But this is a huge component of one of the benefits. Tax-free use of money, as long as you follow what we teach you, all the gains on your cash value, that growth, come to you 100% tax-free. So quick math, if you've got $100,000 in cash value and it grows to 500,000 of cash value and you have a $400,000 gain, we're going to teach you how to take out 500,000 and sometimes even more 100% tax-free. How does that sound?
Hmm. I want you guys to ask yourself a question. Even if you have an existing 401k or an IRA, and suddenly there was a law change and you were able to take out any of your cash at a very nominal rate of interest and have total discretion on whether you ever paid it back, would that asset become more valuable to you right now? Just that alone, just doing that. And I think you're gonna find that, I mean, that would be you'd think that that would be amazing in and of itself, just because you can use the money. And right now, as it stands, you can take some money out, but it's heavily structured with a lot of conditions to get it out and then to repay it. And so I just want to make that point just to kind of jar your thinking.
Yeah, there's a limit of a $50,000 loan on a qualified plan, but you do have to pay it back. And if you leave that job, you still got to pay it back. And I think there's even a shortened time frame where they force you to pay it back. But great point, Steve. That's one
One,
benefit.
just one,
People,
yeah.
yeah, people would just be like, "Oh my gosh, it's amazing. Let's do that." We're talking about four here, but there are really 11
Yeah.
or 12.
Yep, and it goes to the ultimate asset definition, guys. So that's what we're really revealing here.
Yeah. Permanent death benefit. And Steve, you can address this too. There's this idea of buy term and invest the difference. Buy term insurance, right? Cover your life for 20 years, 30 years, etc. But then your life insurance goes away. And the theory is, hey, you've built up all this money in these other investments, so you no longer need life insurance. What would you say to that, Steve?
Let me take a slightly different angle, Barry. So when I was practicing regularly, every once in a while I'd have someone come in and they had a cash value policy with three, four, $500,000 in it. And I got kind of jelly, to use some common language. I was like, what in the world? They got cash sitting in this policy. I mean, it's what really started me thinking on it. And the permanent death benefit is really huge icing on the cake, because as you get older, term life gets more expensive. You can eventually get kicked off, which happened to my dad, even though he's 80 and he's in good health. But when his term expired, he didn't just go get another term policy. It would have been so expensive at that point.
Yeah.
So yeah, permanent death benefit is a massive benefit throughout your whole life, but especially in later years. But even now, every day, I'm comforted to know I have some death benefit, and that would cover my wife and family. So
And as an estate attorney, Steve, if someone does have term insurance that's going to expire, it's not really good planning when it comes to their estate or their legacy. Statistically, less than 2% of term insurance ever pays out a death benefit. We're not saying don't ever have term insurance. There is a place for it, especially if you have children at home and people do die prematurely. That happens. But as an estate attorney, whole life insurance, permanent insurance, this is where someone's getting the true benefit of legacy, asset protection, and estate planning, right?
yeah, because that death benefit's going to expire if it's term, and liquidity problems that could pop up then with the estate where there isn't enough liquid cash to satisfy requirements, then your executor or appointees have to start selling and dumping assets, which has happened in a lot of big cases. Miami Dolphins situation where they had to like dump the team in a fire sale, just as an extreme example. But yeah, so that death benefit's going to expire. When you have it locked in, that's just a key aspect, I believe, of your entire peace of mind, your wealth plan. Just, yeah, it's wrapped into so many things.
It's huge and it's guaranteed. Like if you knew there was a payout going to your family, no matter when you passed away, I believe you're going to have some peace of mind around that. Because what I've seen is when term insurance expires, it puts some pressure on a person. Like they
Yeah.
lose, millions of dollars of death benefit in a lot of cases. And now there's pressure on, okay, my assets need to really perform. I thought I was going to leave my family something larger than I currently have. Well, with permanent death benefit, you don't have that worry. It's kind of like a permission slip. It's a permission slip also for you to spend and enjoy your own assets and then let the death benefit be left to your beneficiary. So I love it from that perspective.
And that's one of the big, real bad pieces of advice, the whole idea of self-insuring, which is a complete disaster piece of advice, if you ask me. The idea that you should just, do all kinds of risky investments your whole life, try to use term, and then self-insure is just, to me, that's the no plan that just falls apart. So,
And would any of us ever consider self-insuring our home or or self-insuring our
right,
car, right? It's like if you've got a mortgage or a loan or state law, you can't. But just the idea, think of self-insuring your home. If you got $1 million house, say, hey, I don't need any insurance. If it burns down, I'll just pay for it myself.
right.
None of us would think that, right? We're going to shift the risk to an insurance company and we're going to sleep better at night.
Yeah, we could go down a rabbit trail right now. Maybe we kind of are, Barry, but I would say if Barry and I actually were just on a podcast with a dude, he's in his 20s. And we were talking about like, what would you give if you could go back? He asked us, what advice would you give yourself? And I would have gone back and said, just fund a policy that you can handle and just fund it all the way up and then never touch it. Because when people are young, particularly, that cost of insurance is cheap. And this is why people like term to begin with, because it's real cheap when you're young. So why wouldn't a person build upon that something when they're young, start it, and then have an asset that's growing for their lifetime? It's just, yeah, it's the peace promoter for the legacy, I think.
It really is.
Yep.
Steve, talk about your self-banking blueprint book real quick. Just to,
Yeah.
second to
Well, I
hype.
mean, that book was written a while ago, and it was really my personal story. So it talks a lot about what caught my attention. I was in my late 20s and met with my uncle who's now passed, but he was quite involved in cash value whole life insurance, and he told me about it at a young age. I wasn't ready to do it, so guess what? I bought a term policy because I had a young family. But later on, it stuck in my head. Another guy talked to me about cash value life insurance and using it strategically. And so it piqued my interest back to that conversation. I always knew that my uncle was a pretty sharp guy, did well financially. And so this book shares about that aspect of my story. And it also offers some intel, some insights into how to utilize strategically designed cash value life insurance in powerful ways for yourself, kind of get people started. And I know, and some of it borrows from Nelson Nash's book. And I know, Barry, your book takes that and probably brings it to the next level. So
Yeah, and my book is just recently out, Live Rich, Die Rich. I call it Becoming Your Own Banker 3.0. It's up to date, wonderful examples, but really teaching a person how they can live rich now, but also die rich. Today, coincidentally, I became a grandpa. My first granddaughter was born this morning. So I
yeah.
think I want to leave a legacy. I want to leave a legacy. And so I not only want to live rich today, I do want to die rich and pass that wealth on to future generations.
Yep, and congrats on that, Barry. We can call you Gramps,
That's
which
right.
I think is fun because Barry always says he feels like he's 35. So,
Yes,
you
you
know.
do. Well, Steve, let's look at some real numbers. I've put illustrations together, and we want to first start with a 38-year-old. Like, how does this work? And when we say that banks own billions of dollars of cash value insurance, what are they doing? The bank owns policies on their employees. It could be their executives, it could be key people, it could be rank and file employees, but they own the policies. The bank owns the policies on an individual. You always have to have a life insurance policy on a person. So we're showing here a 38-year-old owning this policy with 20,000 a year going into the policy. The reason these are reduced commission policies is because most of this premium is going into cash value. There's a bunch of videos. Steve and I have done this. You can check out on the Insurance and Estates YouTube channel. Look up PUA. That's a term you should know. Paid up additions. Um, anyway, a bunch of content
Oh,
there.
I want to say something about Barry. So when Barry does a policy, he does it to the degree that if a person needs to get as much cash as possible into the policy, that Barry designs it that way. So if you think about it, the more cash Barry designs into a policy, the less commission he gets.
Yeah,
Just
that's
want
right.
you to, I just want you to ponder that if you're listening. So this isn't all about maximizing fees, which is a you know, pretty vicious little attack that often happens toward people in our industry, I think. And maybe some of it is earned, but certainly a lot of it isn't. There are a lot of good people that do this stuff. So,
Yeah, thanks for saying.
hmm.
There are two columns right here. One is a guaranteed cash value number. We see that here. And then one's a non-guaranteed number I'll get to in a minute. But notice that the guaranteed cash value in year one is 16,100. So when the 20,000 goes in, is like what, 85, 90% of your premium goes to cash. If this were traditional whole life, like I was talking about earlier, and the kind of whole life that Dave purports to know about, there would be $0 of cash. Okay. And a high commission would be paid, like a $20,000 commission. But the commission here is dramatically reduced because you have $16,000 of cash value and we minimize the death benefit. We do want to focus on two things. I did mention earlier that the guaranteed cash is always growing. So you can see from one year to the next, it's always going up. Even after a person's done funding, the PUA cash is still growing. But it's even better. these insurance companies pay a dividend, and they've paid a dividend every year. This company has never missed a year of paying a dividend in 177 years. So if you're like, oh, I need some track history, I want to make sure this company's solid. It's 177 years of solid dividends being paid to us as policyholders. So we do want to look at the non-guaranteed values because the non-guaranteed values include the dividend, whereas the guaranteed values never include the dividend. So we've got a company here, paid the dividend for 177 years. We're going to scroll down to a little cleaner page to look at right here. Total cash value. Growth is increasing on a compound growth curve. And this column right here that says change in total cash value, this is the increase. So from year 4 to year 5, when the cash value grows from 77 to 100, that's a $23,000 increase. Year 9 to year 10, from 209K to 240K, that's a $31,000 increase. And every year, that increase gets larger and larger. Now, by the way, this person is not locking in to pay $20,000 a year for the rest of their life. The minimum premium on this policy is only $3,900. And so just for illustrative purposes, I wanted everyone to see what would it look like if this person did reduce down to the minimum, and I'm doing this at age 61, which is great, but you could do it earlier or you could do it later because it is a flexible premium. Well, Steve, check this out. At age 61, there's 841,000 in cash value, and 891 is the next year cash value at the age of 62. They put in 3,900. The cash value grew by just over $50,000. That's
Hmm.
compound interest at its finest. That's just
Yep.
so remarkable to see.
So can you guys see why when I started looking at these policies as an estate attorney, I was kind of jelly that I didn't have one. This is what you're really seeing. You're seeing how these things compound and work away to get established, and then they really start to heat up and do some exciting things. And the amazing thing is, the older you get, the more you want stability. And that's when this policy is really working and it offers a lot of options, which I know Barry's going to talk a little more about.
And what if you wanted to get really aggressive with it? Okay, now we're showing this 38-year-old adding an additional lump sum of 80,000 on top of his 20. He's just doing this in the first year. So now we see the contract premium of 100,000. Well, look at this. The net cash value, which includes the dividend here, is 94,764. Now, I want everyone just to think for a minute. I'm showing you numbers right now where over 94% of the premium is going straight to cash value. That's unheard of in traditional life insurance. Most agents don't know about this. They don't know how to do it. And if they do, they don't want to do it because of the dramatic reduction in commissions. But 94% of your premiums going to cash. And by the way, you're getting a $1.5 million death benefit, but you only paid for 105,000 of actual whole life insurance. More on that with some other videos. There's a way that we have to work the MEC limit so the policy still comes to you all tax free. Well, in year 2, now the 20,000 goes in, but he could go down to that $4,000 number, but he could also put in another 100,000. We're not showing it, but there's huge ranges of flexibility here, as low as $4,000 a year, as high as 100,000 a year. And Steve, I love this. Cumulative premium in year 3 is 140,000. That's what he's put in. What's his cash value in year 3? Just over 140,000. This policy breaks even not in 20 years or 25 years. It breaks even in the 3rd year. It's remarkable.
Yep, and he's got free use of that cash. and very flexibly so. If a person wanted to borrow 50,000 at that point and not pay it back for some reason, then it would come out of that large death benefit. So that's just a ultimate asset win right there.
Yeah, now we're going to get to this. This is what some of you have been waiting for. The multiplier effect. Money working in two places at the same time. How in the world is that possible? And Steve, we're going to use your example of what you just said. If someone wants to take out a $50,000 loan, and we saw in that example that there was 140,000 in cash value. So I'm going to write a few things here on my whiteboard. In the chat, if you can see my whiteboard, maybe raise your hand or put in a yes. Let Steve know. I want to make sure everyone can see the whiteboard that says policy loan.
Yep, we got Nancy raised her hand. Still with us. Appreciate that.
Great.
Got some other folks raising hands, so it looks like it's like we're good on that.
So the 50,000.
Hey Barry, somebody anonymous said, I want to cry. If I had this policy when I was 20, I would have over 800,000. Somebody must have done the math. Oh, looking at that illustration, probably.
Yeah.
Well, I wouldn't, you might still have an opportunity, but yes, that is one of the things that often jumps up. I appreciate that comment.
And look, if you have kids or grandkids, start policies on them. I've got policies on my kids and going to get a policy on my new granddaughter that was born today. So yes, there is something to be said for the time value of money. But this comment that we just heard, I hear nearly every week, at least several times a month. I just heard it yesterday. Barry, I wish I would have known about this. I wish I would have heard about you 20 years ago. So for most people, it still isn't too late to start something, whether it's you, a spouse, or a child or grandchild. But you're right. These policies are amazing. And it is unfortunate that you didn't know about this 20 years ago, but you know about it today. Think about how you can move forward. Well, in this example, this $50,000 loan, there's two main things I want to point out. Number one, the insurance company does not physically remove the 50,000 from the 140. So you're still earning interest and dividends on the 140,000 total, which means you don't break that compound growth curve. Because look, if you take $50,000 out of your bank account or your brokerage account or your crypto account or your 401k, you now aren't compounding or having the ability of that money making interest for you or earning a return. Not so in a life insurance policy. You're still earning interest and dividends on the 140,000 total. The way that this becomes the multiplier effect where you're making money in two places at the same time, let's say you take that $50,000 loan and you use it for a down payment on a real estate deal. And I'm a real estate investor. I've done that for 17 years. Well, if you're getting positive cash flow on a real estate rental property and you're making money in your real estate deal, and you're still earning interest and dividends on your 140,000, now you're making money in two places at the same time. That multiplier effect allows you to create more wealth over time. That's what we want all of you to think about. If you just go buy the real estate property without using the policy, you won't earn as much money. And again, we've done webinars on this. You can check it out. Like type in to YouTube on the Insurance and Estates channel, real estate investing using infinite banking, or there's one that's called how to boost your real estate income. There's another one called how to triple your real estate returns. We show all this by using a cash value infinite banking whole life policy. The multiplier effect allows you again to create
Hi,
more
thanks
wealth
for
throughout your
stopping
life.
by, Andy. I'm so glad you did, and as a way to welcome you.
Sounds
Sorry
like
about
Steve, you're
that.
watching the video right now.
I was actually not watching a video. I was trying to copy the channel and put it in the chat,
Oh,
but it started up automatically. So
can you do that? Can you put your channel in the chat?
yes, I think I can here. For some reason, our main video started up. So let's see. All right, keep talking, Barry, and I'll work on throwing that in there.
Yeah. It's a powerful thing. What we want to help people understand is how do you get to the point of building up cash in the policy. So our three-step blueprint to building wealth, number one is you do need to determine the amount of money you want to put into a policy. This is consistent investing. You either set it up for a monthly premium, a quarterly premium, a semi-annual premium, or an annual premium. And Robert Kiyosaki, in his book Rich Dad Poor Dad, he called this paying yourself first. Now, some of you might say, you know what? I'm just going to put money in my savings account, my high yield savings account. I'm going to just keep putting money in my 401k or IRA or my brokerage account. I'm going to just keep buying crypto. Just whatever you do, make sure that you're as safe as you can possibly be. And when I say that, safety and mitigating risk come with education, come with gaining more knowledge. That's why Steve and I have written books, and Steve's got another book, which is the title of our webinar today, The Ultimate Asset, right? You could read that, but
Yep.
it's, yeah, education. We want people to get educated. And the more education you have, the less risk you take. So Robert Kiyosaki says, pay yourself first. We recommend paying yourself first in a cash value whole life policy because of all the benefits, the guarantees, the things we've talked about today. If you choose to do that somewhere else, that is your prerogative. But please do it with knowledge, do it with education. Make sure that whatever you're investing in, you know about. Don't just be a speculator and blindly put money into something not knowing really what you're getting into. So that consistent investing, as the gentleman or person mentioned earlier, they wish they would have done this 20 years ago. That would have been 20 years of consistent investing. Two, once you determine that, start the policy. We can help you run your numbers, but be sure that it is structured correctly. This is huge. I've looked at hundreds, if not thousands, of other people's life insurance policies, their illustrations, and I can't tell you the number of times they are not structured the right way. And structured the right way, there are videos about this on the YouTube channel, but in a nutshell, high cash value. That's the goal. You want as much cash value as possible. And there's a caveat to this. Some of you may just be interested in death benefit. You might say, look, I'm never going to take a policy loan. I want to leave a huge legacy, a large legacy to my beneficiaries, my children, my grandchildren, my great grandchildren. Well, then in that case, we can still structure it for a death benefit play that's tax free to beneficiaries. So in this case with infinite banking, the properly structured design is maximum cash value. Step three, use the policy, and I'll teach you how to use the policy. Take policy loans, and number one, buy assets. Buy assets that will create more wealth throughout your life. So for me, when I look at a real estate deal, I would like a double-digit cash on cash return. I put in X amount of dollars. I want my cash on cash return to be at least 10% or more. Now I'm creating more wealth. It's an asset. I have a tangible real estate property. It's giving me positive cash flow every month. I'm able to pay off my policy loan and my bank loan. I'm getting tax benefits. There are tax advantages for real estate. Some of you might say, well, I want to invest in crypto. Well, one way to do it, what if you set up a Roth IRA, like a mega backdoor Roth IRA, and now you buy crypto in your Roth, and now all the gains come to you tax free? That's another way that you can make more wealth. But taking a policy loan, you can buy crypto, you can buy real estate, you can invest in your business, you can buy cars and toys as well. But our number one education when it comes to policy loans is we want you and we want to teach you how to buy assets. One of the things that I do with my clients, Steve, is when we're all wrapped up getting policies in place, I send them a list of 5 to 7 real estate investment companies that are turnkey companies where they can take a policy loan, invest with this turnkey real estate company, and now they're making money and it's pretty much hands off, which is great. So that list comes to my clients who are interested in those types of deals. Buy assets, create more wealth throughout your life, and use this multiplier effect where you're making money in 2 places at the same time.
Yeah, great example, Barry. So the wealthy buy assets, the wealthy use assets to buy assets, and in order to increase the return and utilize that value, that equity. So really good stuff for you guys. I did post a few links in the chat to our books and ebooks. Our blog, which has, you can search that blog and you can get any kind of information in a pretty in-depth article typically. We spend a lot of time on those articles. And then, of course, the YouTube channel. If you guys want to look at that, social proof looks like, right, Barry?
Yeah, after everything that we've said, everything we've done, everything we've shown, if you're still thinking to yourself out there, is this legit? Should I do this? Well, I've got on the board like major companies, the major banks we've already gone through. All these companies, corporations, banks, wealthy people like Walt Disney from the past, they all have cash value insurance. So you might say, oh, there is something to this. Maybe there is something to what Steve and Barry are saying. And maybe I shouldn't have all of my money in the market. Let me get more diversified. So we encourage people all the time, look at your own numbers. The social proof is there. Go back, watch the webinar, but look at your own numbers because this is where we're going to drill down on what's best for you. We want to help you meet your goals. So look at your own numbers, and I think you'll find that over time, you'll be happier year after year after year by having this ultimate asset in your portfolio.
Yeah, and to use, I guess it'd be a biblical reference, there's a scripture, godliness with contentment is great gain. I always look at this as a slow tortoise kind of different approach to wealth building. And not that it's even that slow, you can do a side by side, but the whole point is that this is a methodical, intentional way for people to get on the right track in terms of their money momentum. So just offering that. Somebody asked Barry in the chat, how do we qualify for this program? You want to touch on that?
Yeah, primarily an insurance company is going to look at 4 things: your health, your age, your income, and your lifestyle. Now, lifestyle is obviously smoking, drinking, things like that, but also are you jumping out of airplanes, racing motorcycles? Because they take on risk, right? If a person passes away, there's a death benefit that has to be paid out. We have clients that are on medications and that are diabetic that still get approved, but look at your own numbers. They are going to usually ask you to do a blood and urine sample. Not all the time. There is accelerated underwriting where you may not have to do that, but they are going to take a look at those things, doctor's records, and ask you some health questions.
Right. And somebody else just asked, when do you guys get a copy of the recorded? So we take the registrations and we will shoot out an email with a recorded version once you've had have a little bit of time to upload that to YouTube. So give us a little bit of time on that. It'll probably be tomorrow, and you'd have a recorded version as well. And if you're watching on YouTube, we'll put a link. If you want to look at your own numbers, we invite you to schedule a time to chat with Barry if you feel like you're ready to look at this and how this can work for you. And with that, I think we're wrapped up. Appreciate all your participation. Love the questions and comments. And we'll have more of these live webinars in the future. Looks like we may have gotten, yeah, we've got a couple more questions, but I think they're more life insurance industry kinds of things. If you're wondering about the products, if you're wondering about commissions, the best thing to do is to do the one-on-one with Barry. And I know he's happy to explain all that stuff with you, why we choose the companies we do, what are the commissions, how much is that accounting for, whatever, how the numbers work within insurance companies. So anyway, I appreciate it, guys. Barry, you have any parting thoughts?
Just appreciate everyone taking the time. This is you investing in yourself, and we're always about that. Read the books, watch the videos, continue to get what Robert Kiyosaki called financial literacy. And as you do, you'll make better decisions. You'll make more money throughout your life. And as Buffett said, don't lose money. And what we're showing you here today is a way that you make money guaranteed every year. So take a look at your own numbers.